Right, before we get into anything else, I need you to stop what you're doing for just a second, because what I'm about to share with you could save you from a very stressful phone call from HMRC, and trust me, that is not a call anyone wants to receive. Now, you might have heard people say there's a magic number, a cash amount you should never withdraw from your bank all at once, and here's the thing, it's real, it's not a myth, it's not some internet rumor. There are actual thresholds, actual rules, and actual automated systems quietly watching bank transactions across the UK right now as you're watching this. But here's what most people get completely wrong about this. They think it's just about cash. They think Hummer C is only watching big lottery winners or business people. They genuinely believe that as a pensioner, as someone who's worked hard their whole life and is just trying to manage their own money, nobody's watching them. And that assumption? That's exactly how thousands of seniors in the UK have accidentally triggered financial investigations they never saw coming. So today, I want to walk you through 5 things that almost nobody is telling you clearly. We're going to cover the actual figures Hummer C flags, why withdrawing just under that amount can backfire even worse, a little-known rule about gifting your savings that catches families completely off guard, what your bank is legally required to report about you without telling you, and this is the one that genuinely surprised me when I found it, how perfectly innocent everyday behavior can look suspicious on paper. Stay with me on all of these, because by the end of this video, you'll know exactly what to do, what to avoid, and honestly, you'll probably want to share this with someone you care about. Let's get into it. So let's start with the question everyone comes here to get answered. What is the amount that gets flagged? The short answer is £10,000, but here's where I need you to listen carefully, because the short answer is only half the story. Under the UK's Proceeds of Crime Act 2002 and the money laundering regulations, which have been updated and tightened significantly since Brexit, banks in the UK are required to file what's called a Suspicious Activity Report, or SAR, whenever a transaction raises certain red flags, and one of the clearest red flags is any cash transaction at or above £10,000. Now I know what you're thinking. I'm not a money launderer. I'm not involved in crime. I just want to take out a bit of cash for a new sofa, or help my daughter with her house deposit, or pay a builder, and you're absolutely right. You know that. But the system doesn't know that. The system sees a number, checks it against a threshold, and files a report. That's it. No nuance, no common sense, just a flag. And once that flag is filed, you can find yourself in a position where you have to explain, sometimes in writing, sometimes in an interview, where that money came from, what it's for, and why you took it out in cash. For most innocent people, that process is stressful, embarrassing, and time-consuming. For some, it can temporarily freeze access to their own accounts while the review is underway. Now, you might be thinking, okay, fine, I'll just take out £9,500, problem solved. And that brings me to the next thing I need to tell you, because that thought, that very logical, completely understandable thought, is actually the thing that makes it worse. This one really matters, so I want to make sure I explain it properly. There's a practice called structuring, and it's something Hummer C and financial investigators are trained to spot immediately. Structuring means deliberately breaking up transactions to avoid hitting a reporting threshold, and in the UK, structuring is itself considered suspicious behavior, even if the money is completely legitimate. So let's say you decide to take out £9,800 this week, and then another £9,500 next week, and maybe £8,000 the week after that. In your mind, you're just being careful. In the bank system, a pattern has just appeared that triggers a much more serious review than a single £10,000 withdrawal lever would have. Because banks aren't just looking at individual transactions anymore, they're running pattern analysis across weeks and months. If your account suddenly shows multiple large cash withdrawals happening close together, especially if that's unusual for your normal spending habits, that's flagged as potentially deliberate avoidance. I know, it feels deeply unfair, and honestly, I think it is unfair on regular people who have no idea these rules exist, but knowing this now means you can protect yourself. The practical takeaway here is this: if you genuinely need a large amount of cash for a legitimate reason, a home renovation, helping a family member, buying something significant, the safest thing you can do is tell your bank first. Ring them up, explain what the money is for, and let them make a note on your account. It takes 5 minutes and it can save you weeks of headaches. But speaking of helping family members, that actually brings us to something that catches a lot of seniors completely by surprise, and it has to do with gifting. Now, here's one of the most common situations I hear about, and it usually goes something like this. Mom or dad has a bit of savings money they've built up over decades of working, saving carefully, going without, and they want to help their children or grandchildren. Maybe it's a house deposit, maybe it's a wedding, maybe it's just because they can and they want to. That's a wonderful thing. It's one of the most human things there is. But here's where HMRC gets involved in a way most people never expect. Inheritance tax and the gifting rules. In the UK, you can give away up to £3,000 per tax year and it will be completely exempt from inheritance tax. That's your annual exemption. You can also give small gifts of up to £250 to as many individuals as you like, and there are special exemptions for wedding gifts: £5,000 to a child, £2,500 to a grandchild. Here's the part that stuns people. Any gift above those limits could be subject to inheritance tax if you pass away within 7 years of making it. This is called the 7-year rule, and it doesn't matter that the money came from your savings. It doesn't matter that you had completely innocent intentions. If you gave your son £50,000 to buy a house and then sadly passed away 4 years later, your estate could face a tax bill on that gift. The rate tapers down over the 7 years, so the longer you live after making the gift, the less tax applies, but in the first 3 years, the full 40% inheritance tax rate applies. Now, I want to be clear, this isn't HMRC being vindictive. It's a system designed to stop people transferring all their assets to avoid inheritance tax right before they die. The problem is that it catches completely innocent, generous families in the crossfire. The solution is straightforward, but most people don't do it. Keep records. Write down what you gave, to whom and when. If it's a substantial gift, consider getting a solicitor to draft a simple letter confirming it. It takes almost no effort and can spare your family an enormous amount of stress and expense later. But there's something even more eye-opening coming up, because we've talked about what you might do that triggers a review. What about what your bank is doing without telling you? This one surprised me when I first looked into it properly, and I think it will surprise you too. Under the UK's anti-money laundering laws, your bank has a legal duty to report suspicious activity to the National Crime Agency, and here's the crucial part. They are legally prohibited from telling you they've made a report. That's not a typo. They cannot tell you. It's called tipping off, and it's a criminal offense for the bank to warn you that a suspicious activity report has been filed on your account. So you could, right now, have a report sitting with the NCA that you know absolutely nothing about. You'd continue going about your life, using your account, and have no idea. Now, before I stress anyone out, the vast majority of SARs are filed, reviewed, and quietly closed with no further action. The system processes hundreds of thousands of these reports every year. Most people whose activity is flagged never hear another word about it. But, and it's an important but, if the NCA decides there's something that warrants a closer look, things can escalate. Your bank can be instructed to freeze or restrict your account while a review takes place again, without being allowed to explain to you exactly why. For most people watching this, the practical protection is this: keep your financial life consistent and explainable. If you've always paid bills online, always kept a few hundred in cash, and your spending is relatively predictable, you are almost certainly fine. Where people run into problems is sudden, unexplained changes in behavior. A pensioner who's never taken out more than £200 in cash suddenly withdrawing £15,000? That's going to raise questions, even if the reason is completely innocent. So if your circumstances change, if you're about to do something financially unusual, tell your bank, create a paper trail, be the person whose account makes sense. Now, I promised you 5 things, and the last one is the most unexpected, because it's not about big amounts or one-off transactions. It's about something you might be doing every single week without thinking twice. All right, this is the one I want you to really sit with, because most financial red flags aren't triggered by dramatic events. They're triggered by small, repeated, innocent patterns that when viewed on a spreadsheet look odd to an algorithm. Here are some real examples: regularly depositing just under a round number. If you're receiving cash payments for something, maybe renting out a garage, selling items at a car boot sale, or helping a neighbor with a bit of gardening, and you consistently deposit, say, £490 or £990 month after month, that can trigger a pattern flag. It looks like someone deliberately staying under a threshold, even if you genuinely just happen to earn about that much. Frequent cash deposits from multiple sources. If you're receiving small amounts from several different people, maybe your children chipping in for a shared holiday or a family event, and they're all landing in your account as cash deposits in the same week, that can look on paper like a layering pattern, which is what investigators look for in money laundering. Unusual international transfers. If you have family abroad and you send money overseas regularly, that's perfectly normal for millions of UK residents. But if the amounts vary irregularly or the frequency suddenly changes, it can draw attention. Using a reputable transfer service and keeping records of what the transfers are for is good practice. Paying tradespeople in large amounts of